All right, well, thank you all for coming. We really appreciate the judges coming and especially for giving us some really valuable feedback on our ideas. We want to start the way all good business cases should start, which is what are the needs of the client? The needs of common fund clients, they're mostly expressing concerns over lower investment returns, an inability to find appropriate managers, and concerns over violating fiduciary duty when it comes to making ESG investments. So since those are the primary concerns, those are the top of mind for investment committees, we want to make sure that the solution that we come up with and that we present today is mindful of those primary concerns. So that's what's driving our philosophy. First, that we must satisfy the fiduciary responsibilities of fund administrators. We need to align with the core competencies of common fund and fit within their existing business model. We take into account ESG concerns, especially environmental risks. Through our survey of common fund clients, we found that out of environmental, social, and governance concerns, environmental was certainly what they were talking about most, what their stakeholders were talking about most, particularly as it relates to carbon emissions. So while our solution is flexible as those priorities change, we focus primarily on carbon at this stage. Lastly, we need to be flexible and realistic. Flexible in that, again, as these priorities change, that our products can change with them, but realistic, that this can actually be implemented, that you could put each of our suggestions into practice on day one. So these were the driving motivations behind our solution. So our approach was to design separate ESG-aware frameworks for each asset class and then demonstrate that those frameworks yield attractive risk-adjusted returns. So we're going to take an asset class by asset class approach because we think each one is unique and needs a customized solution. We're going to leave the individual fund selection to the people who do it best, common fund. We're not going to stand up here and give you a list of 70 different funds that we think should go into a fund-to-fund, wash our hands with it, and go home. We think that A, is inflexible, but also we don't have a competitive advantage of doing that. So we're going to leave that to common funds and outline a framework for approaching this. So with that, I'm going to hand it over to Xiao.
So based on the philosophy and the approach mentioned by Jason, we actually developed two options for our clients. Here's the option one. So common fund will play a role as an outsourced CIO, which means our target client is the small and medium clients. So we will offer the holistic portfolio to them with the expected return at 9%. And this is the weight for each asset. The next option is to offer very customized option to our clients. And this is available to all clients, and our target clients is the large clients. Because we think they have more capability to develop the strategy to maybe just invent one asset, such as private equity, to meet their specific requirements about the exposure to ESG. And you can see the number under each asset is the expected return we designed for this kind of strategy. And we will address how we come up with these numbers in each part later. So let's look at the public equity. You may wonder if the ESG equity can generate more returns than the normal one, but actually based on our research, we feel ESG selection equity cannot generate consistent return over the longer term. But we're still using that. Why? Because of the risk. We actually gave the scores based on the ESG factor to each equity, and we choose the top 20% performance equity. And we assume they have the same expected return, and this kind of equity, they have fewer extreme values, and their volatility is actually lower. So we think the ESG equity is working. And how should we manage them? From the left part, you can see this index comparison, and the social index actually outperforming at the similar risk compared to the normal index. So the passive way actually works. So what about the active management? We let the active managers select the best performance ESG equities, and you can see it actually outperformed the index by 1.67%. However, considering about the 2% management fee, we don't think it worth that. So our decision is to go just passive for the public equity. So here's some historical data about the index performance. You can see the MSCI World ESG compared to the MSCI World Index. They actually generate very similar return, given the similar risk. And for the domestic equity, it's like more positive, because you can see some social index is actually outperforming the traditional index, giving very similar risk too. So our conclusion is that although we are narrowing down the selection of equity to just the ESG, it can still perform in a very similar way to the traditional index.
Thanks, Xiao. So let's look at the fixed income part of the portfolio. And we think this is a very important part of the holistic portfolio option. It's offsets some of the higher risk assets and provides stability. So we divided our fixed income portion into 30% green bonds, 40% green project bonds, and 30% US Treasuries. And just to clarify, green bonds fund green projects. Primarily so far, they've been focusing on energy-related projects. The market for them has been growing pretty rapidly in the past few years. It's been dominated largely by multilateral development banks and government groups, but recently corporations have been issuing green bonds as well. Green project bonds also fund green projects, but don't necessarily have the green label. They do have to meet certain criteria to be included in the S&P Green Project Bond Index, for example. Just some examples of organizations that have issued green bonds recently. There's a mix of public and private, and we can see our own state of Connecticut in here. And from a performance standpoint, green bonds do not underperform. They perform just as well, at least, as other bonds in general. So if you look at the S&P Green Bond Index on the left, it performs similar to Barclays Global Aggregate Index over a recent 6-year period. And on the right, the S&P Green Project Bond Index actually outperformed other bond indices. It only underperformed in comparison to high-yield corporate bonds. So we're going to take an active management approach to the fixed income portfolio. And when we look for bonds, we're going to look for bonds that come from organizations with high credit ratings. And we'll initially focus on MDBs and government groups for several reasons. So some examples might include the World Bank or the state of Connecticut. And with that, I'll pass it on to Isis to talk about private equity.
Private equity takes up 23% of our total portfolio, and we do hope and expect that the private equity return is outperform the public equity market. A lot of investors handpick the greenish managers to invest, while the research shows that the managers invest exclusively in the ESG area has very disappointed return compared to the universal PE managers. And also a lot of managers take into ESG factors into their consideration has difficulty to measure the performance of the ESG factors. So we have a different approach. We're going to select the high-performance managers and hedge the industry risks that the carbon brings through a fund-of-fund manager approach, and then the fund will be have a lockup period for 2 years. How are we going to constructing this portfolio? First, as I said, we will select the high-performance managers with a preference of the managers from emerging market, where the market growth is higher, but the risk is not necessarily high. And also, we prefer the managers with a proven track record to avoid probably the agency risk and so on. And then we were hedging the carbon intensive industry risks by shorting the public equities or the related index at the portfolio level. So by doing this, we can retain the operational incremental value gain from the private equity investment. Here are some examples. Let's say a plastic packaging company with a 20% annual return invented a new packaging material which makes them has exposure to the oil price risk. We're going to mitigate this risk by shorting the basket of publicly traded plastic and petrochemical company, and also the related index to that. Let's take a look of the private equity return expectation. According to Cambridge Associates, the average return of the private equity manager across the whole world in the last 30 years is 16.6%, and our hedge cost is about 0.5%. By subtracting that, we got an expected return about 16%, which could satisfy a long-term return requirement from the endowment fund clients.
So next we're going to talk about hedge funds. So we think that hedge funds have a valuable role in an institutional portfolio to deliver equity-like returns that are uncorrelated to the public equity markets. However, the ESG-aware hedge fund universe we do not think is developed enough to meet the risk and return characteristics and requirements of institutional portfolios and fiduciary duty. The number of dedicated funds remains small. There's a wide variety of strategies, and it's very difficult to look through a portfolio into the underlying holdings and evaluate an ESG impact from that perspective. So we took, I think, a little bit of a different approach. We created, using Common Fund's existing standardized fund-of-funds product, we identified the benchmarks for each fund, and then each hedge fund in the fund-of-funds. Then we hedge out the carbon-intensive industry risk by shorting the subsector-specific indices. So using this formula, we take out the portions of the index in the entire basket that are exposed to those carbon risks, like, for example, a carbon tax. You'll also see that last factor at the end, we add back in a factor of using oil futures because we don't think that our basket of our fund of funds should take a directional bet on oil. We don't think that's responsible. We don't think that's our job or really our competitive advantage. So by adding that back in, we remain oil price neutral. So we actually did this. We went out, we created this hedge, and we measured it against the Barclays aggregate returns for hedge funds over the last 10 years or so. And we saw that the performance cost of the hedge that we're talking about was about 51 basis points. That also came with a slight reduction in monthly volatility as well. So the Sharpe ratio of the two is roughly equivalent. So we think by taking this approach, our fund-of-funds product remains ESG aware, hedges out some of the carbon risks, but also satisfies the fiduciary duty requirement. Lastly, we want to talk about real estate. And real estate is really a totally different ballgame when it comes to the development of the sector. There's a substantial amount of empirical evidence, theoretical research, academic articles that show that making a particular property more energy efficient and greener actually lowers operating costs, increase the rents that you can get from commercial properties, and reduces the cost of capital. So we think that that green real estate is a valuable part of the portfolio. One of the indices or the sustainability benchmarks that exist is GRESB, which is backed by a number of large pension funds that looks through publicly traded REITs into their underlying assets, rates them across a wide variety of sustainability metrics, and then produces an overall rating for the REIT. So what we did is we selected the highest scoring REITs in that performance index, or in that sustainability performance index, and we graphed the overall financial performance here, and we show that they actually have higher levels of returns over a number of different time horizons. So we think that by putting together a basket of green REITs, we can have good financial exposure to the real estate sector. So with that kind of deep dive into the asset classes, we're going to come back out to the overall holistic portfolio level and talk about what's the role that our product plays in our clients' portfolios. First, we take an environmental focus. It serves the top priorities of our clients right now, but it allows for component flexibility. So as those priorities change, we can change the industries that are being screened out with our hedges. We can change the passive exposure on the public equity side. So it remains flexible to the changing needs of our clients. We target an 8% nominal return. We think the portfolio that we've put together has a slightly higher than that expected return. And that satisfies the fiduciary responsibilities of our clients. We think that's really the most important thing for them, and we think we've cleared that hurdle. Speaking of clients, we think that our portfolio is suitable for all clients that are seeking either an asset class specific ESG exposure for the larger clients, or a total portfolio solution for the smaller ones that don't have in-house CIO to make their asset allocations. The minimum investment in the commingled fund, we think $10 million is appropriate, with a fee level, a pretty standard fee level of around 40 to 45 basis points. We think that allows for to cover the costs of an actively managed fund-to-fund structure. And lastly, our impact measurements. You'll notice that our solution that we've communicated today does not have an overarching ESG metric. We don't think it's appropriate. We don't think that there's any valid way with all these different asset classes, with all these different exposures, to have something holistic and one size fits all. So our reporting focuses on an asset class by asset class basis to give our clients transparency into what they're investing in while still remaining responsible and flexible going forward. Thank you. One quick, can you use your microphone because it's being recorded? Sorry.
So I have one basic grounding question. One of the things that people sometimes say about ESG is that it's poorly defined and poorly measured. How did you approach that, the definitional aspect of ESG and the measurement aspect?
So we started with thinking about how would our clients define it, because they're the target. So our research focused on what are our clients worried about when they talk about ESG, what are they talking about, how do they define it? Most of our research centered around especially carbon emissions and global climate change, something that's very present. So when we thought about ESG is obviously very broad, but our portfolio, we used basically what our clients are talking about as a definition. But then as those change, in 10, 15 years, our solution remains flexible, so as their definition of ESG changes, we can change too.
So is it really E then?
Primarily.
How you defined it? And then what sources did you use to measure the E in the different asset classes?
Well, we took an asset class by asset class basis, so it's going to vary. With the REITs, for example, we use the GRESB ratings for the individual portfolios. With hedge funds and private equity, where you don't have the look-through and the control over the underlying portfolio nearly as much, we took kind of an industry macro perspective that here are the worst offenders, and we're going to try to hedge out the exposure to whether it's climate change, stranded assets, carbon taxes, any of those type things. But we weren't able to come up with a way to hedge it more specifically than that, just because you don't have the control over the portfolio.
And I want to add a point, because for the public equity factor part is a little bit different, because we have a passive measurement way, and the index actually is designed based on the ESG, and lots of research centers, they give the scores, they give grades to each part, so we can easily rank them and just choose the top performance equity based on all the factors.
I'll just follow up on this. So what is the actual carbon intensity of the portfolio?
We don't know.
Because this is the framework. We didn't handpick all the different
But each of the companies in each of those indexes has an actual carbon intensity.
For example, the private equity fund, we actually select the high performance managers, and we make the brown portfolio in our fund selection as less as possible. And we actually short the related industry to reflect the risk that the whole investment brings. So we don't have exact carbon intensity in our framework.
So I would just think as a manager, managers, you'd want, there's a phrase called trust but verify. So I don't see the verification. I see the trust, but I don't see the verify. And if I were an environmental NGO that wanted to mission align my portfolio, I would want to know numbers like how many tons of carbon am I taking out? How am I contributing to removing the limit?
I think we will definitely have a different approach to your requirements, but now we are facing to the client of an endowment fund. They have a fiduciary obligation to bring the necessarily return to meet their spending needs and inflate to mitigate.
They also have a fiduciary duty to remain in business, and part of their mission, part of their fiduciary mission, is to accomplish that. With the recent Department of Labor shift, that ESG information is meaningful, that could be very helpful.
We will take away into consideration. Thank you very much.
The emphasis on hedging out carbon, very clear. But what do you think is the probability that there's going to be a carbon tax, or there was going to be stranded assets, and in what time frame? Because let's say you put this hedge on, but nothing happens for another decade. How are you thinking about that?
So I think the probability of there being stranded assets, we've seen it, I think, already with the with the huge drop in oil prices. Lots of oil companies are running down the value of their reserves pretty substantially. So I think that saying whether or not there will be stranded assets, 100%. The question is how much will that be and what will be the impact on those companies. I think that's a much more difficult question. In terms of the probability of a carbon tax, I think that it's the way that you've seen it, see things developing globally. I mean, our portfolio is global. So if you think about what's the probability of a carbon tax applying anywhere in our portfolio, it's already in there. There are carbon taxes in some European countries, and there's price on carbon in certain U.S. states. So I think it's already there. And the question is, how much does this expand and how quickly?